Hi, John at Executive Focus. I want to talk to you a little bit about a couple of concepts around investing. Now, this is not investment advice. I am not an investment advisor, and I do not play one on the internet. This information is for informational and educational purposes only. I want to talk today a little bit about two important concepts in investing. One, dollar cost averaging, and two, position sizing. Dollar cost averaging, what is it? Whenever you're going to make an investment, you should have thought through why you're making the investment, what are your goals, what are your objectives with that investment. For example, let's say I want to make an investment in a broad-based index fund. Index investing is a very, very smart way for most investors to get started and continue investing throughout their lifetime. One popular option is VOO. VOO is the ticker symbol. That is Vanguard's ETF that tracks the S&P 500. What does that mean? It means it's a product essentially that tracks the activities of the S&P 500. So it's kind of like buying a little teeny piece of every company in the Standard & Poor's 500 index, okay? The 500 largest companies in the S&P. So buying a little piece of those gives you a nice broad-based diversification into all of those stocks, all of those companies. And it's a good, smart way for a lot of people to invest. Most professionals on Wall Street don't beat the index, okay? Something like 80% of them don't beat the index. So already you have an opportunity to buy something that is beating Wall Street, 80% of the professionals on Wall Street, which is kind of interesting. But what do I mean by dollar cost averaging, position sizing? Let's take dollar cost averaging. So you've done your homework and you want to buy this broad-based index called VOO, VOO. VOO today is trading a little over $400. Let's say you have $25,000 that you want to invest. Well, you could just go out and take $25,000 divided by 419, which I think is what it's trading at, and that's how much of it you could buy. Or just you can buy partial shares as well. You could just buy $25,000 worth. But what if it goes down tomorrow? And what if it goes down the next day? What if it goes up? Well, you don't know and I don't know. And those clowns on Wall Street don't know. Nobody can predict the future on what's going to happen. But one way that you can think about it a little bit more strategically is through dollar cost averaging. And what I mean is you've got this lump sum, you've decided $25,000 is how much you want to invest. One approach could say, I'm going to take $1,000 of that every week for the next 25 weeks, and every Monday morning, I'm going to buy VOO, $1,000 worth of VOO. Why would you do that? Well, a bunch of reasons. But one smart one is if I'm buying the same amount all the time, I'm essentially dollar cost averaging into the market. So over 25 weeks, I'm going to invest $1,000 or 25 months. You can just do it monthly also. But what's interesting is you're buying the same amount every time. So when the stock market has gone up, you're buying less. But when the stock market has gone down, you're buying more. So you're automatically buying more strategically because you're buying more stock when the market is lower. That's kind of cool. That's dollar cost averaging. And it's one way to kind of ease strategically into your investment and in your investment strategies over time. And so one very smart strategy, I think, is let's say you make X amount of money every year and you've made a decision that you're going to put away 10% of that for your future in investments. And so every month you just take some segment of that and you buy VOO or some other broad-based index that you like and you've done the homework on. But again, over years, you're going to always be buying less when the market's high and buying more when the market's low. And strategically, that comes out to be a very smart strategy over the long haul and can make you a lot of money that way. And you just kind of put your investing on autopilot so that you're not thinking about it, you're not worrying about it. The last thing you want to do is be watching it every day and panic when the market goes down and want to sell. A lot of people do that. That's a losing strategy. Be patient. You've done your homework. You knew what your goals were. You're investing for the long haul. Okay, that's dollar cost averaging. And that can be a very, very effective way to manage into your investments over the long haul. Let's talk about position sizing. Position sizing is another strategy where it says, you say, okay, I want to invest some amount of money. Let's say $10,000. Do you want to invest it all tomorrow? Well, you could, and that's one approach. Maybe you've done all your homework, you have your objectives, you think NVIDIA is going to continue to keep growing with its push in its AI chips, so you want to buy NVIDIA stock. You've done your homework, you've done the analysis, you think the price earning is about right, you think it's got room to grow. One way is to go out and buy $10,000 tomorrow. Another approach would say, well, I want to watch it over time. Their earnings announcements coming up. I want to do another analysis after they've made their earnings and announce them. So maybe you take that $10,000 and you buy 10% today or $1,000 worth. And then you do some more analysis. They have their earnings. You still think it's a good buy. You buy another 20%, $2,000 more, or 30%, $3,000 more. So you're strategically kind of getting into the stock over time. You're sizing your position to think about what makes sense for you and what your objectives are. You could do this with any asset class or any stock, whether it's an index fund like VOO, a company like NVIDIA, or even a company like Microsoft. But what's important is you've not jumped in all at once or out all at once. So sometimes position sizing is important as you're getting out of a stock. Let's say you bought NVIDIA 5 years ago and it's had a heck of a run. But let's say it's hit your goals and you want to take some profits. Would you want to sell it all? Some people do. Sometimes that makes sense. But you still think it's a great company. Maybe you sell 30% of your position or 50% of your position, or maybe enough to cover your initial investment, and get your money back, and let the rest ride for another year or another 6 months or another 5 years. I tend to be a long-term investor. Some people are more like traders and trading in and out of stocks. I think that's kind of a fool's errand. I like to look at the fundamentals of the company, the leadership of the company. And if I'm going to make a bet, I'm going to hold on to that stock for a long time. But everybody's different and your strategy may be different and you need to do what works for you. But position sizing is another way to move in and out of a stock a little bit more strategically by thinking about how much. You don't have to put it all in today or tomorrow. You can break it up into more strategic chunks that make sense for you and your objectives for that stock in your personal financial situation. So, 2 concepts to think about, dollar cost averaging and position sizing. 2 ways to think about how to move into a stock over time or out of a stock over time. That's just a little bit more strategic than just a buy or sell. Okay? All right. I'm John from Executive Focus. That's it for today. Have a great day. Good luck, good selling, and good investing. Take care.